Now that we know what the next ibond inflation rate will be starting in November of 2024, you're probably wondering, should I buy my ibonds in October or November? Let's just go through the difference. In October, you know exactly what the inflation rate is and what the fixed rate is. That inflation rate is 2.96%. The fixed rate is 1.3%. So the combined or composite rate comes to 4.28% overall. There's a little factor that bumps it up more than that amount if you're adding it along with me. So for November, the ibond inflation rate is going to be 1.90%. That's a full percentage point lower. Now we don't know the fixed rate. I'll talk about that in a second. I think it might just go down to 1.20%. So the expectation I have for the November ibond rate is 3.11%. As you're looking at November, the projection is 1% lower, mainly from the change in the inflation rate. Because even if the fixed rate stays the same, we're still seeing a full 1 percentage point lower amount in November. Of course, too, if you're buying ibonds right now and you're looking at 4.3 or 3.1%, chances are you can find one-year type of investments like a CD or a treasury rate that's coming in above those numbers. And when you're buying an ibond, you cannot hold that, or rather you cannot cash that in the first 12 months. So I think the best comparison for an ibond is how does it look against a 12-month interest rate account like a CD or 12-month treasury. The reason then you might be buying an ibond is not for the high interest rate, since it looks like you can get a better 12-month rate elsewhere. It's really for that fixed rate. And as you're looking at the fixed rate, trying to decide between October and November, we know what the fixed rate will be in October. We do not know what the fixed rate will be in November, although the signs are pointing down. When it comes to the fixed rate, there's absolutely zero formula at all. But my friend David Inna over at TipsWatch has been trying to create somewhat of a projection on there. The way he projects things out is he says, let's take a look at the real yields, what the TIPS market is showing for an interest rate, and apply a 65% factor to it. If you take a look at that real yield right now, those real yields are averaging 1.9%. You look at David's formula of 65%, and we're coming in then at 1.23%. So you say, well, will they round up to 1.3, go down to 1.2? Again, there's no exact formula. That's what seems to be a good projector. My expectation is that they would round down to 1.2. If you look at May of last year and you look at these numbers of what the real yields were coming in as, they were at about 2.1%. You look at the last 30 days of those real yields, while this has been an average over the past 6 months, the past 30 days, the average is more towards 1.57%. So it seems like the trend is going down, which leads me to believe that when the Treasury sets that fixed rate, it seems like it will go down. Again, there's no formula, but you know for sure what the October fixed rate is going to be. So when you're trying to decide, should I buy in October or November, take a look at the overall interest rates, but especially take a look at the fixed rate. And a lot of times I suggest go with what you know. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.